Good day, everyone. My name is David Williams, Executive Director of the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Carbon Pricing Costs for Households and Revenue Recycling Options in Canada. We're grateful to Jennifer Winter from the University of Calgary for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations, along with a host of other products and services that you can find on our website at www.iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our speaker. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for our speaker, please click the Q&A button at the bottom of your Zoom window and type your question. We've allocated sufficient time at the end of this webinar to address your questions. And now I would like to introduce you to our presenter, Dr. Jennifer Winter, Associate Professor in the Department of Economics and Scientific Director of the Energy and Environmental Policy Research Division at the School of Public Policy at the University of Calgary. Jennifer, over to you.
Thank you very much, Dave. I'm just going to share my screen. All right. So welcome, everyone, and thank you to the IAEE for the opportunity to present. Before I start, I want to acknowledge that this is joint work with Brett Dolter at the University of Regina and Kent Fellows at the University of Calgary. And I'd also like to acknowledge that this work is funded by the Smart Prosperity Institute Research Network and its Green and Growth Partnership. So today I'm going to talk about carbon pricing costs for households in Canada and progressivity of revenue recycling options. So here's the background, and of course it is rather obvious that carbon pricing raises the cost of fuels purchased by households, so gasoline, diesel, natural gas, and then of course electricity in jurisdictions that burn coal and natural gas. And the carbon pricing is also passed through to consumers when embodied in the goods and services purchased. And in Canada, and I think in many places around the world, there are concerns that carbon pricing will cost the low-income households disproportionately. And in Canada in particular, as a policy itself, it is quite politicized, despite the fact that it is market-based and, as we know, the least cost way to address emissions. And then, of course, there are many options for spending carbon pricing revenues, and that is part of the political discussion in Canada. So we have emissions from firms and from household use, and these revenues go to the government. In this instance, this is the House of Commons in Ottawa. And a lot of the political discussion in Canada suggests, or it absolutely ignores the fact that carbon pricing revenue has some value in that it can be used to fund goods and services. And so the political discussion often totally ignores it and treats it as if the government is collecting the funds and then burning it. Instead, we could, of course, spend it on things that we value, like healthcare or education. There's nothing particularly special about carbon pricing revenue. And for, I think, most provinces, there is no legislated requirement to return the revenue in any specific way. And then the other options, of course, are to return it by either cutting income taxes, cutting a sales tax, cutting checks, or supporting industry. So this is would say the options that we're going to explore and the part of the political discussion in Canada. And to give you a sense of how politicized this issue is in Canada, here is just a sampling of attack ads and op-eds opposing the carbon tax in Canada. So, the arguments are it's a very high cost, it's just a tax grab, it's not an environmental policy, etc. And as part of the policy design in Canada, there's also a separate system for large emitters. And so that has provided fodder for opposition to carbon pricing because it's it's handouts to companies while families pay the full burden. So part of what my co-authors and I are trying to do is put all this information out there about the potential carbon tax costs to households and the role of different revenue recycling policies in addressing many of these concerns. So we have 5 research questions associated with the work we're doing. So, first is just what are energy use patterns of Canadian households, and correspondingly, how do these energy use patterns affect the cost of carbon pricing, the tax burden of carbon pricing on households, and how do these effects differ across Canadian provinces and income quintiles within each province? And I'll get into this a little bit later, but the energy systems and patterns of use differ quite a bit across provinces. And so it means that there are non-trivial differences in carbon tax costs associated with those differences in energy use. Second research question is, of course, what are the expenditure patterns of Canadian households? So what are households spending on energy? And what are they spending on other goods and services, and how does that affect the indirect effects of carbon pricing? Third is, what is the net financial impact of revenue recycling options? So we haven't finished our analysis yet, but what we intend to do is we want to model every province's specific policy, as well as specific exemptions and a variety of counterfactual scenarios to create a full picture of the policy options associated with both carbon pricing and revenue recycling. And that, of course, leads to our fourth research question, which is, are carbon taxes progressive or regressive, and how do revenue recycling options change this? And then finally, what is the role of complementary support policies for business, such as the output-based pricing system, in mitigating costs to households? And I'll get into more detail about what exactly an output-based pricing system is right now. Or later. Okay. So our approach to this is we are interested in how carbon pricing will impact households throughout the income distribution. And so as a starting point for analysis, we're using publicly available data from Statistics Canada's survey of household spending, which is aggregated into within quintile averages for each province. We use utility billing data to convert expenditure to imputed energy use. And then we also have synthetic microdata that we use to look at the full distribution of costs across Canadian households. And so all those together, we're determining the direct costs of carbon pricing on households, and then we'll use an embodied emissions model to estimate the indirect carbon pricing costs. And then we use a tool called the Social Policy Simulation Database and Model, SPSDM, to estimate the distributional impacts of revenue recycling policies. So I'm going to go into the policy context to give a little bit more of the understanding of how carbon pricing in Canada works. So I'm assuming that not everyone is familiar with it. And then I will move into our specific methodology, and then talk about the results for both the quintiles and then the synthetic microdata. So to start off with, all right, so this is a Government of Canada graphic from, I believe it's 2018 or early 2019, which shows the distribution or the different types of carbon pricing systems in place in Canada that were going to be in place in 2019. So we have the green provinces that had a provincial or territorial system in place. There are these yellow territories that chose the federal system, and then the purple provinces, where the federal system was imposed on those provinces. And I'll get into detail about why it was imposed in just a few minutes. And this is what carbon pricing policies look like in Canada today. So in just a few short months, we've had massive changes in policy. And part of it is elections, part of it is the politicization, part of it is federal provincial relations. But we have territories that chose the federal system. We have one province where the federal policy was imposed. We have some provinces where there's a provincial large emitter system and a federal top-up. And then the green provinces are the ones where the provincial or territorial system was accepted by the federal government. So the principles behind the carbon pricing in Canada is something called the Pan-Canadian Framework, which was introduced in 2016. And the principles behind it was pricing carbon, first and foremost, well, pricing emissions, combustion emissions, minimizing carbon leakage and competitiveness impacts, and a commitment to recycling the revenue to mitigate impacts on households and firms. And then a series of complementary policies related to emissions that are hard to price or hard to measure and hard to price, and in many ways pet projects of the government in order to speed the energy transition, and then also some principles for adaptation. There are two parts of the pricing system. The first was the federal benchmark, which is a minimum standard that provinces' pricing systems needed to meet. And so it was an explicit pricing system. It could have been equivalent to BC's carbon tax. So that's a tax on combustion emissions, or a hybrid system of Alberta pre-2019 under its previous government with a carbon tax plus a large emitter system, so output-based pricing. And then an increase in the price from $10 in 2018 to $50 in 2022. Or provinces could implement a cap and trade system, which would cover a broad base of emissions similar to the BC carbon tax or the Quebec cap and trade system. And then associated with that cap and trade system, provinces need to have an emissions reduction target that was at as or more stringent than Canada's 30% reduction in 30% below 2005 emissions by 2030, and then declining annual caps as part of the cap and trade system. If provinces did not, if their pricing policies did not meet that benchmark, what's called the federal backstop would be imposed. And this is a policy of two parts. So it's a levy applied to fossil fuels. So this is a levy applied to all combustion emissions associated with fossil fuels, from natural gas, diesel, gasoline, pretty much anything that is combusted in an internal combustion engine. And then the second part is what's called this output-based pricing system. And it's all facilities with emissions greater than 50,000 metric tons of CO2 equivalent per year were subject to this output-based pricing system. And smaller facilities that were in designated industries, designated as emissions intensive and trade exposed, could opt in. This included emissions from combustion and industrial processes and product use. So the price would actually apply to a broader scope of emissions compared to the levy on fossil fuels. And the way it works is there is a product or sector-specific performance standard, and firms are given emissions credits equal to their output multiplied by that performance standard, which is an emissions intensity. In some cases, it's also multiplied by an emissions factor, which just scales the amount of credits that firms are allocated. And then firms have these credits available to them to offset the cost of compliance with output with the carbon price, and then they pay at the federal carbon price rate where their emissions exceed the performance standard or the technically the amount of credits available to them. For all intents and purposes, that scaling factor isn't used very often, and so it's basically that the payment is at the federal carbon price where emissions exceed the performance standard. And so this has the effect of keeping the marginal price of currently $30 per ton, but lowering average costs for firms. Okay, and so this gives you a sense of the coverage of the policy. And this is Canada-wide emissions. It's based on 2015 emissions. And so you see that if the federal backstop was in place across the country, the tax would cover 44% of emissions, output-based pricing would cover 35%, and about 21% of emissions would be uncovered, compared to just a federal benchmark where it's a BC-style carbon tax on combustion emissions. Coverage of the carbon tax would be 72%. Of course, there is a substantial amount of variation within provinces, which I will get into. So I'm noticing a question. So the carbon tax applies to emissions within Canada and does not apply to embedded emissions in imported goods. So it's combustion emissions or industrial processes and product use within Canada. Okay, now here is the electricity generation mix by province, and you can see that there is like quite substantial variation in sources of energy or electricity within Canadian provinces. And this is going to turn out to matter quite a bit in that we have the provinces of Alberta, that's AB, Saskatchewan, SK, and then New Brunswick and Nova Scotia, NB and NS, that rely fairly heavily on both coal and natural gas for electricity generation, which translates into more emissions intensive electricity and then translates into higher carbon tax costs for both households and industry. In contrast, we have several provinces where the dominant electricity source is hydro, and so that means that the dominant source of carbon tax costs is going to be personal use of, say, transportation fuels and then natural gas where applicable. Okay, so I'm going to now get into our methods. So we're imputing direct energy use from expenditure. So J designates energy type, P is province, and T is time. So we have aggregate expenditure on a certain type of energy, say natural gas for home heating. we divide that by whatever the prevailing sales tax rate is in the province of the household's residence. We take away fixed costs and then divide by whatever the price of energy is. And we're using that utility billing data to determine what the fixed costs and the prices are. And that gives us energy use in natural units. And then we construct costs by multiplying this energy use by an emissions factor associated with that type of energy times the carbon tax price, which is P. Now we also need to calculate indirect costs, because these turn out to matter quite a bit. So we do this through a two-stage process. So first, we're using an equivalent of an input-output table, but instead of the input-output table being GDP or trade flows, it's emissions, embodied emissions in those trade flows. And we use a coverage estimates of the sectors of the economy subject to that output-based pricing system in accounting for how that output-based pricing system will affect the indirect costs in the industrial and commercial sectors. And then we convert these embodied emissions to emissions intensities, and then map these onto data on household spending by quintile and region. So we have a series of household expenditure categories, and so we're mapping emissions intensity of a specific expenditure category, say financial services, for example. And then we use that to calculate we aggregate that up and calculate the indirect costs. To briefly show you the math behind this, what we're attempting is to solve this system for an unknown matrix Y of total priced emissions, which is a function of these indirect price upstream emissions and direct priced production emissions. And and so I think I've covered most of this, but we are able to identify a set of priced emissions intensities. The one thing I will comment here is that due to data availability, our indirect cost estimates are based on 2011, whereas our 2011 emissions intensities, that's the input-output table that we have available to us, whereas our direct costs are based on 2017 expenditure. So a bit of an inconsistency there, but it's unfortunately all what we have to work with right now. Excuse me. So the revenue recycling options that we're interested in is we are matching the policies to within province revenue. So what does that mean? That means, like, for any given province, there is going to be the levy applied to fossil fuel combustion, as well as some revenue associated with that output-based pricing system. Or we also have a scenario without the output-based pricing system, so just a flat tax across all combustion emissions within the province. And so within the borders of a province, we take the revenue that's available and we simulate an increase in the personal income tax basic exemption. That's a sales tax rate decrease, a means tested sales tax dividend, or sales tax credit, sorry, and a lump sum dividend. So when I was facetiously saying that that governments could cut checks, that's what I meant, just a lump sum dividend to all households. And so our constraint is that we're only available to use revenue raised from the carbon tax within a province to to fund these revenue recycling options. Okay. So now it's time to get into the results from the quintiles, and we've spent a lot more time on the results from these quintiles, and so it's a lot more detailed, and so I'll spend the majority of the rest of my time before we get into the microdata results. So to start off with, here are the trends on household expenditure on energy across in each province and across the income distribution. And so again, this is based on publicly available aggregated data by quintile. And what I think is particularly interesting is that we have relatively similar patterns, but the energy mix is quite different across provinces. So one thing I will point out to you is that, for example, Quebec Quebec, New Brunswick, Nova Scotia, Prince Edward Island, and Newfoundland and Labrador. So these are ordered geographically. Once we hit Quebec, there is far less reliance on natural gas as an energy source and far more reliance on electricity, and compared to, say, Alberta and Saskatchewan and the western provinces. And then the other point I will make about this is that expenditure on energy is relatively higher in higher income provinces, which are, no surprise there, Alberta, Saskatchewan, and Ontario. Here is energy expenditure as a share of consumable income, or share of total expenditure. And I think there's a sort of really interesting pattern between the first and second quintiles, but then as expected, we have energy expenditure declining as a share of income. And the fact that the share increases as you move from the first to the second quintile, and that's a relatively consistent pattern across all provinces, to me indicates that there might be some budget constraints issues for the first quintile. But that's not the purpose of this paper, so I'll just put that aside for now. Here is imputed household energy use by province and by quintile. And you can see that, as expected, we have energy use increasing with income, and also, interestingly, relatively higher energy use in Alberta and Saskatchewan. So just want to point out that the relatively high expenditure amounts in Alberta and Saskatchewan are not necessarily because of high energy prices, it's also because of high energy use. Okay, and here is our basic results of average costs within quintile by province. And the takeaway from this is that we have a bunch of provinces that have relatively low costs. So, and those provinces are Quebec, no surprise, Ontario, and and Manitoba. We have some middle bin provinces, and then Alberta and Saskatchewan are outliers. And they're particularly outliers when you look at the upper end of the income distribution, in that the upper quintile for Saskatchewan has carbon pricing costs double or more than double the highest quintile in other provinces, which is pretty significant. And this gets to the issue of, indirect costs primarily, and the emissions intensity of the electricity grid in Alberta and Saskatchewan, as well as in Nova Scotia. And so that means that not only are electricity costs relatively higher for those provinces, it also means that electricity costs for businesses in those provinces are relatively higher, and we see that pass through. And I'm sorry I neglected to mention that we are assuming 100% pass through from firms to households. And the reason for that is we want to construct an upper bound estimate of the potential total carbon tax costs. And I see a question, and sorry, what are the units? Of course, these are 2020 Canadian dollars. And so this is, so for example, our estimate is the average carbon tax cost for the lowest income quintile in British Columbia is $206. And here I'm just presenting available revenues versus the total household cost. Again, this is 2020 dollars, units are million. And so I'm comparing it with the output-based pricing system and without the output-based pricing system. So let's just look at the province of British Columbia. So the available revenue is 798 million. And that is what the province could raise from combustion emissions within the province, as well as the emissions associated with large emitters. Total household costs is 813 million. So that's the average cost within each quintile multiplied by the number of households in that quintile and then summed together. And the reason that total household cost in British Columbia is greater than the available revenue is that BC is a net importer of goods and services. So more, there are embodied emissions that are priced within Canada that are being imported by residents of British Columbia. And then without the output-based pricing system, available revenue in British Columbia is 982 million, slightly higher, and that's because there is the, we're not, in this scenario, our counterfactual government is not spending money allocating these emissions permits to large facilities. And because we're assuming 100% pass-through and we don't have that offsetting effect of lowering average cost for large emitting facilities, household cost or total household cost is higher. All right, so here is our estimate of carbon tax costs. Again, no surprise, increasing with income, relatively higher in Alberta and Saskatchewan. Here is carbon tax costs as a share of consumable income. And this is almost, but not quite, a measure of the tax burden. And I wanted to show this because it replicates some of the pattern. It replicates the patterns we saw in energy expenditure as a share of consumable income. Here is carbon tax cost as a share of total income. So this gives us the average tax burden by income. So fairly standard measure of progressivity, or regressivity of a tax. And we see that carbon taxes in Canada are quite regressive, and the impacts on the lowest income quintiles are substantial. And so to me, this justifies concerns about the potential negative distributional consequences of carbon pricing. We are missing British Columbia in this picture. We're still sorting out some of the analysis there. Okay, this, I recognize that this is a fairly ugly graph. This shows the net rebate. So rebates less carbon tax costs for the 4 revenue recycling scenarios. So the top is the means tested sales tax rebate. Dark blue is that lump sum dividend. Light green is a provincial or is a sales tax cut, and dark green is at the bottom basic income tax exemption increase. And so in this graph, positive means that the rebate to the income quintile is higher than our estimated costs. Negative mean costs are greater than the rebate. And we see that means tested sales tax rebate and the lump sum dividend are progressive means of revenue recycling, in that we have costs for the lower income households that are less than that rebate, whereas the provincial sales or the sales tax cut is somewhat ambiguous, and the basic, the increase in the basic exemption for income tax is regressive. Now, here I'm going to show you our estimate of carbon tax costs without that output-based pricing system. And what you'll notice is that the indirect costs are substantially higher, particularly in Alberta, Saskatchewan, New Brunswick, and Nova Scotia, so the provinces with higher emissions intensity electrical grids. And to give you a sense of the difference, here is our carbon tax costs with the output-based pricing system, and here it is without. So you can see we've quite the change in scale. And so for the highest income quintiles in Alberta and Saskatchewan, for example, the carbon tax costs almost double because of that increase in indirect costs. Here's carbon tax costs as a share of consumable income. So again, you see relatively high burden on these lowest income quintiles. And here's a comparison of our primary results with the OBPS without. Here's the net rebates without the output-based pricing system. And we see the same patterns, but what's particularly interesting is that the dispersion in the net rebate or net cost is much, much larger. And there are 2 reasons for that. One is, again, we're assuming full cost pass through from firms to consumers, which again is in many ways an unreasonable assumption, but it does give an upper bound on carbon pricing costs. So that means that all costs are being passed through, but it also means that without the output-based pricing system, governments have, in some instances, quite a lot more revenue to play around with. And so that means that net rebate to households, particularly with the lump sum dividend or a means tested sales tax cut, is quite a bit larger. So here's the results with the output-based pricing system, and you can see the units almost double. So the rebate doubles, costs also effectively double. All right. I do want to briefly talk about the microdata. So this is synthetic microdata constructed within SPSDM. And so the results are not directly comparable, though they are based on both so the synthetic microdata is based on the is based on the survey of household spending. It's just synthetic, so to address data confidentiality issues. And here is the distribution across provinces of carbon pricing costs. And you can see there is actually quite a bit of difference in the distribution of costs across provinces. And excuse me, here is a violin plot of the exact same distributions. We've just elongated the scale because I think it shows some of the patterns a little bit more. We see that Alberta and Saskatchewan have really flat distributions, whereas Ontario and Quebec have lots of density in quite low cost areas, and then the other provinces have sort of a mix of flat or relative, or in the middle, relatively flat distributions. Here is our estimates of net return for our provincial sales tax cut, and the blue line at 0 is where households are exactly, they're no better off, or with the tax, and sorry, their net rebate is 0. So there are some households where our estimated costs are exactly equal to the estimated rebate. And particularly interesting is that we do have some provinces with very narrow distributions, whereas other provinces have a lot flatter distribution. So this is the sales tax cut. Here is the lump sum, and here in particular, we're modeling the specific federal policy. So we only have 5 provinces which had that federal policy imposed. And in, I think it's particularly interesting here is that we have quite a, more than half the residents of the province that have a net rebate that is positive. So the rebate is higher than expected carbon tax costs. And that's a construction of the policy, in that the federal government is choosing to use some of the revenue raised from small businesses to fund the lump sum dividend to households. And here is the return for a sales tax credit applied. And here the distribution is strange. the patterns are strange, yeah, but interesting by bimodal distribution across all of the provinces. And then we also have a high concentration in a return somewhere around $500. That's consistent across provinces. And here is the net return for the basic income tax exemption increase. So similar pattern to that sales tax credit. Okay, I recognize that I'm slightly over time, so I do want to wrap up quickly. So to conclude, I think the choice, like fairly obviously, the choice of revenue recycling method affects whether carbon pricing is progressive or regressive. We do find that carbon pricing is regressive. So for politicians and policy advisors that are concerned about the impacts of carbon pricing on lower income households, it speaks to the importance of a complementary policy to address that specific issue. So that the federal backstop, so the output-based pricing system, levy on combustion emissions combined with a lump sum dividend, is a progressive means of redistributing carbon pricing payments. And I think one of the things that really surprised us is that the industry support, so that output-based pricing system does have a non-trivial role in reducing indirect costs, and one that we really didn't think about when we started working on this. And I think it's particularly interesting, and also a side effect of, I think, an unintended side effect of a policy that was really meant to address competitiveness and trade exposure in Canadian industry as an adjustment to carbon pricing. And so that policy, combined with the household costs, as that policy is phased out, we can expect to see indirect costs to households increase. Next steps, we intend to complete analysis for all provincial policies, which is a bit of a dimensionality problem because every single province has some unique quirks about its policy, and we want to replicate the same revenue recycling. We want to include a few different progressivity measures in a more formal way. And then we're going to publish all of our results on a specific website for households and politicians to have a look at, and look at the different consequences of different revenue recycling policies. And then farther in the future, we intend to include behavioral responses to carbon pricing using a general equilibrium model. But for the time being, we have more than our hands full trying to model all of the changes in policy in Canada. So thank you so much for your time, and I look forward to other questions. So there is a question. Will all the schemes and rebates I've discussed still provide an incentive for households and industry to reduce their carbon emissions? So yes, but we have to think of several scenarios. One is essentially like a business as usual, the absence of carbon pricing that has the highest associated emissions. Other scenario is just full carbon pricing, where there is no rebates to households, no support for industry. That's going to cause the greatest emissions reduction. And so what I've described is somewhere in the middle, where we have emissions pricing, we have a revenue recycling policy, and we also have support to industry. So that is mitigating the cost, but we still do have that same marginal incentive on all goods and services. So there will be emissions reductions. They just won't be as large as if there was no revenue recycling and the government took the revenue and, say, burned it or spent it on other things. And next question is, do exporters of goods and services have to pay the tax, or do they get a rebate? The tax is on combustion emissions within within Canada and in each province's borders, and there is no adjustment for exporting. So there's no rebate. And that's one of the reasons behind that output-based pricing system. It's instead of providing a rebate to firms that are based on their combustion emissions for firms that are exporting goods and services, the choice was made to just address the export issue and competitiveness through the allocation of emissions credits. Okay, so I'm just waiting for more questions. Yes. Has this tax already been implemented? Yes. Carbon pricing is in place across Canada. The prevailing rate is at $30 a ton, though as I showed at the start of my presentation, there is variation in policies across across the provinces. So I can give you let me go back to near the beginning, and I can tell you specifically what policies are in place. Okay. So British Columbia has a carbon tax on combustion emissions. Alberta has its own provincial large emitter system. It is an output-based pricing system, just the standards are slightly different than the federal system. Saskatchewan has a provincial output-based pricing system, which is not very stringent. And so there's a federal top-up on that large emitter system, as well as the levy on households and small businesses, which Alberta has as well, the federal levy on businesses and small businesses and households. Manitoba, which is the dark blue, has the federal backstop fully imposed. Ontario just has just announced actually that there is a provincial large emitter system plus the imposed federal levy on households and small emitters. Quebec has a cap and trade system. The rest of the Atlantic provinces, so New Brunswick, Nova Scotia, PEI, and Newfoundland and Labrador, have provincial systems which generally have a carbon tax on small emitters and households, and some form of large emitter system, though New Brunswick decided to go with a cap and trade system for large emitters. So you can see that there is actually quite a bit of variation in policy in Canada, which is interesting from a policy analysis perspective, but also also somewhat annoying from a policy analysis perspective, because it means that we have to do an analysis for each province of the federal system and then whatever the provincial system is, which means a lot of work, and why we've been working on this paper for 2 years now. So I guess in the absence of any other questions, Rebecca, I will turn it back over to you.
IAEE wishes to thank Jennifer Winters for an outstanding webinar. This webinar will be available on IAEE's website for future download. If you're not a member of IAEE, we encourage you to join by visiting www.iaee.org. We thank you for attending, and I now officially close this webinar.